What's up, guys? So today I decided it would be a good idea to have a financial advisor on. This is a really good friend of mine. His name's Eddie Sorrentino. He's a financial advisor and he's very qualified. So I figured having somebody like him to go ahead and educate a lot of us on finances and whatnot, how to, elevate yourself would be a good idea. So Eddie, so who are you? What do you do? Who do you work with?
Sure. My name is Ed Sorrentino. I'm a financial advisor at Equitable Advisors, a Fortune 500 company. We've been around since the 1850s. Publicly traded on the New York Stock Exchange under the ticker EQH. And I believe on the Fortune 500 list, we're right around the 298 mark. So we're within the top 300 companies in the world. I've been doing this for around a little bit under 2 years now. I got started in the industry at 18 years old. Cold calling, lead prospecting for senior advisors. After college, went ahead, got my licenses, and I'm actually looking to take my CFP, my Certified Financial Planner exam, within the next 24 months.
So Ed, tell us something that has to do with investing at a young age and why it's so important to do it at such a young age.
So when you're a young individual, right, you have an asset that's on your side, which most people don't, which is time. So you have time to make the proper investments in the right allocations. More often than not, especially my older clients that I come across where they haven't planned for retirement, right? They don't have the privilege of having time in the markets where your internal rate of return is compounding annually, right? To have exponential growth in your accounts.
Right.
For young professionals, obviously depending on what kind of industry you're involved with, what kind of income you're receiving, it's very important to get started, especially in retirement plans, such as funding your 401k, your IRAs, traditional and Roth, right? Your life insurance plans. Because by doing so, you're setting yourself up for retirement, but you're also setting yourself up where you're able to compound interest, right, annually.
Right.
Okay, if your internal rate of return is 10%, let's just say, right, which by the way, the S&P 500 over the last 100 years is around 9.5%. Over the last 10 years is around 11.2%. But for hypotheticals, argument, let's just say 10% internal rate of return, that's compounding annually. Let's just say you start with a $10,000 account, right? And you're getting 10% a year. Your first year, you're gonna make $1,000, right? But instead of starting year two with just making 10% off $10,000, you're gonna be starting year two with making 10% off $11,000.
That's compound interest, right?
Compounding interest.
Compound interest.
Exactly.
Which, again, if you guys have watched my videos, I just made a video before about the Roth IRA, explaining about the compounding interest and stuff like that. So if you're not aware, you should check it out.
Now there are situations where, yes, on average, the markets yield around 9-10% a year, right? Like I said before, the last 10 years. So from 2012 to 2022, the markets have actually, and the S&P 500 I'm referring to, has yielded around 11.2%. Right, that's
right.
Compounding annually.
Right.
Right. That's because of multiple factors, right? Fiscal, monetary policy of the Fed. But reality is, you want to make sure that you're invested in the right indexes, right? In the right ETFs, mutual funds, stocks. Okay. Yep. Be well diversified in a multitude of sectors, and you also want to make sure that you have these assets placed in the right accounts. Okay. And keep in mind, if you have money sitting in a regular brokerage account, which are post-tax contributions, and when you buy and sell on an annualized basis, you're taxed at that capital gains basket or bracket,
right?
Which federally is around 15%. Okay. It's important that you want to be able to utilize these tax-free vehicles, such as Roth IRAs, such as cash value life insurance. So when you do build your assets and they're compounding annually, 10, 15, 20, 30 years from now, you don't have the burden of such a hefty tax consequence,
right,
upon the sale or liquidation of those assets.
Okay, so could you just explore what kind of vehicles would be recommended for young investors?
Absolutely. So it's important to understand what your discretionary income is, especially when you just get started and you start receiving either 1099 or W-2 income, right? Maybe you work for an employer, you'll receive a W-2 income, which means that there's federal withholding taxes taken out, FICA, Medicare, all that jazz.
Right.
But if you're a 1099 employee, where you're an independent contractor, the definition of a 1099 employee, right, which means that you make your own income, you're able to deduct a little bit more. But regardless, it's important to understand what your discretionary income is. Now, for high income earners, okay, even if you're a young professional, maybe you're a lawyer, doctor, right, financial advisor, and you're in a high income basket, right, you want to make sure that you get maybe a little bit of a tax haircut now, but also you want to place allocations or certain assets in allocation where gains on your growth are tax deferred and maybe even tax free in your distribution years of your life. So for high income earners, right, I always suggest putting a little bit of money into your traditional side of your 401k plan, if you have a 401k plan available, and then also a little bit in a Roth component of a 401k plan as well. So individuals under the age 50, right, can actually put up to 22 and a half, doesn't include matching, in their 401k plan. If there is matching, the company can actually put a grand total of $66,000 into your 401k plan for year 2023. Right? Now keep in mind, when you put money into your traditional 401k, right, yes, taxes, right, your contributions are tax deductible now, but the growth is tax deferred. And then once you're over the age 59 and a half and you can legally take out money from your 401k plan, that distribution is actually taxed at your ordinary income basket, right, your bracket. Now on the Roth component, okay, contributions are post-tax, so you won't get the tax deduction now, but gains are not just tax deferred growth, right, but they're also tax-free income when you distribute after age 59 and a half. Now keep in mind, with the traditional IRA, contributions are pre-tax, so you'll get the tax deduction now. Gains are tax deferred, but then after age 59 and a half, any distributions you take out of your IRA, traditional IRA, that will be taxed at your ordinary income bracket.
Right.
Okay. Now with a Roth IRA, okay, contributions are post-tax, so you're not going to get a tax treatment now, right, a tax deduction now, but gains are tax deferred, and also income after age 59 and a half, right, is tax free. But there's limitations to Roth IRAs. You can't make over $144,000 in adjusted gross income.
Right.
All right, but there's ways around it. You know, working with a financial advisor does have its perks.
Right.
So for high income earners, sometimes it makes sense to contribute to that traditional IRA, and then during down years, right, it's called a backdoor Roth, you convert the traditional IRA into a Roth IRA, right? You'll pay the taxes then, but anything going forward, since it's in a Roth IRA component, is actually tax deferred and then tax-free income after age 59 and a half.
Right. So it's important to know that, you know, working with a financial advisor, there are things you could do such as rollovers, right? That's basically what you're describing as the backdoor method, right?
Right.
So that's why it pays off to work with somebody like yourself.
Right.
For people that don't know.
Yeah. So, you know, during COVID, yeah, these stocks dropped 30-40%, some of these things, but then 6 months later, they're back at all-time highs. So it made sense to pay taxes, right, on those securities and that conversion then, but then the entire growth where it's back at all-time highs, some of these companies, all that income, where really the gains are tax deferred, but then they're also tax free on the back end after age 59 and a half, and you're distributing income to yourself and you're financially independent. Now when it comes to rollovers, let's just say you worked for an employer, right, for 10 years, and you built up your 401k to $150,000, right? It's very important to roll over your 401k after leaving that employer, right, into an IRA for a multitude of reasons. You know, 401k plans, they can be very expensive on your end. There's fund fees, money manager fees, administration fees, annual fees.
Yep.
So when you roll it over into, meaning your 401k plan, into an IRA upon your departure of your employer, you have many other options, such as not just being able to invest in funds, but you can invest in individual stocks, right? Debt instruments like bonds, corporate bonds, ETFs, rather than just what's mitigated within that 401k plan. And plus, there's also deduction fees. When you roll your 401k into an IRA, there's less fees, less administration fees, fund fees. Really, the sky's the limit. So you're actually saving yourself money, and you have a more variety of investment options when you roll over your 401k plan into an IRA. You can't do that if you're still with that employer, but if you leave that employer, right, you get a new job, or you have a new boss, you're able to roll over your 401k plan into an IRA, which is what I always suggest my clients to do.
So, Eddie, what investments would you recommend for older professionals and business owners instead of young professionals?
Sure. So, there's a difference between good debt and bad debt, right? Bad debt is where you'll take out a credit card, you go to Macy's, and you buy a million things for your girlfriend, all right? That's bad debt. Good debt is where you'll take out a loan, okay, invest it back into your company or business, right? And eventually the income derived off that loan, right, or CapEx, the CapEx rate of return, outweighs the interest rate you're paying on that loan. So by default, you're making profit.
Yes.
Okay.
One of the most evident mistakes that I have seen with my own eyes is how people can't wait and actually they inflate their lives. And what I mean by that is called lifestyle inflation. So as their salary increases, their lifestyle also increases. Now, if a simple rule of thumb would be to just do the best that you can, and instead of inflating your life, just buy assets or invest. Like, for example, what we're mentioning here. So instead of blowing your money, if you just waited a little bit, I would say, 10 years maybe, and go ahead and invest it, long term it's going to pay off. And then sooner or later, you're going to see your friend, like when he was 19 or 20, pulling up in a, Porsche, and then when you're 30, you can buy a Bugatti because you invested so early. And he didn't. Also, living paycheck to paycheck, I think this is a great way to get out of that, because most Americans, I believe the last time I checked the stat, it's 70% live paycheck to paycheck. And why do you think that is? I would say it's because of lifestyle inflation. So I read a book a while ago. It's called The Millionaire Next Door. I would highly recommend that you guys read it if you haven't read it. And it was basically about how a person who was only making around $50,000 a year versus somebody who was making almost more than double of his salary ended up being far more wealthy long term, not short term, long term, because he followed this simple rule of thumb, which is be aware of lifestyle inflation. All right. The definition of lifestyle inflation is as income increases, some people tend to increase their spending on non-essential items, which can lead to financial instability in that long term. So, overlooking small expenses, frequently neglecting to track and manage small and regular expenses like daily coffee runs. Dude, everybody goes to Starbucks. I like Starbucks, I do. All right?
I don't like Starbucks. I like Dunkin'. If I'm going to get coffee, it's going to be Dunkin'.
But doing that small coffee run every single day, it's compounding, okay? Whether you want to admit it or you want to be not as aware of it, compound interest can be your best friend and it could also be your worst enemy. So, just be aware of that. That's all it is. Dining out can accumulate over time and impact your overall financial health. Remember, it's just good to develop good financial habits regularly and to view your spending and saving patterns to avoid failing into these common money traps, which, again, a lot of us fall into. There are also many more things that you guys should look into, like impulsive buying, high interest debt, which not the good kind, and neglecting savings. Okay, I think we should all have at least 10 grand saved up just in case something happens. I think that's like a good rule of thumb.
Well, the rule of thumb is really, if you make $100,000 a year, right, you want to have $50,000 in emergency savings. Okay?
Even better.
Because you always want to have 50% or 6 months, right?
Right, 6 months.
Just in case, because you may lose your job, right? Things happen all the time.
You never know.
A company can go bankrupt. Okay, in 2008, which was such a horrible time for the economy, right? People were homeless, people were losing their jobs. Okay, if they did not have 6 months of emergency reserves, what were they doing? They were suffering, right? These people were really doing very poorly.
Yeah.
Okay, so you always want to have 50%, right, at least in emergency reserves based on how much income you derive in an annual time frame.
Another very important thing that I want to ask you, when it comes to credit cards, because I know a lot of people, especially in college, I don't know their exact stat, but there are many who are in credit card debt, and it's not good. Well, do you give any advice on that, or what would you recommend? Or do you think they should wait till after college when they have a salary so they can pay it off, so they're not they're not paying interest up up to Yahoo. What do you think?
Yeah, so if you had the option between paying off debt and paying or investing in the markets right now, it pays more to pay off debt, okay, because interest rates are so high. So let's just say, for example, if a client came to me and they had $25,000 in discretionary income, right, but they had $50,000 in debt, right, whether that be mortgage, whether that be credit card debt, student loan debt, whatever the case may be, business loans, I would suggest before we implement any type of investment vehicles or utilize any type of investment strategy, I would say it's best to pay off debt now. Now, if interest rates were back in 2020, 2021, when interest rates were very close to zero, it would make sense to invest in investments, right? Like stocks, okay, ETFs, mutual funds, whatever the case may be. But right now, because of the high interest rate environment, right, it pays more to pay off debt.
The ROI is greater with debt paying, yes?
Yes, because interest rates, especially on credit card debt, interest rates on credit card debt are not the prime rate. They're north of 20%, okay, which is absurd. So that means if you have $10,000 in credit card debt, you're paying at least $2,000 a year just in interest. And those include late fees, those include the annual charges, all right? So if your interest rate is 20%, right, and stocks only yield 9% a year, right, but in this high interest rate environment where stocks are probably going to suffer the next 12 to 18 months, it makes sense to pay back your debt rather than to invest in the markets. Now, if it was 3 years ago where interest rates were close to zero, then I would say the opposite. Yes, it pays more to buy stocks right now than to pay off your debt. That's not the case, all right? So it pays more to pay off your debt now, right? So what I would suggest is focus on paying off your debt now, right? And then when the markets get a little bit healthier, interest rates come down, your debt balance comes down, then I would say get a little more acclimated to, buying into some investment vehicles, right? And taking on a little bit more risk in the market.
Right, so just make sure, guys, that, again, I always reiterate this because you gotta make sure, do your own research, even when talking to a professional, okay? Obviously, having somebody with knowledge is good, but at the end of the day, you should make your own financial decision, okay? You should make your own plan with somebody or without somebody. Just remember, stay consistent and be patient. I mean, building wealth does take time and it takes discipline. Stay committed to your financial goals and just, as you go, adjust your strategies as needed. So
that's great. The way I conduct my business is that unless you make money, I don't make money.
Fiduciary, correct?
Of course. And for small clients getting acclimated, and keep in mind, I have very large clients, but for clients that are my age, still getting their feet wet with investments, my plan is to just properly allocate your funds now, right? Even if it's just $1,000 a month going into a cash value life insurance plan, or $500 a month, which I have set up for some clients, going to a Roth IRA, right? It's going to build up in the long term, all right? Now, once you're working with, a few $100,000, and you've grown and you've made profit, that's when a financial advisor, that's when we'll get paid, right? But it's really important to be open to working with a professional, all right? Because really of our knowledge, there's so many things are changing all the time. On legislative side, where taxes are probably going to go higher the next 5, 10, 15 years from now, all right, because the United States debt is around $33 trillion. So how are we going to pay off that debt? We're going to have to increase taxes. It's the only way to pay off this debt.
Yikes.
All right, and going back to 1913, all right, we're actually in the lowest federal tax bracket right now, right, based on history. Okay. Going back to World War I, World War II, right, obviously taxes were higher to pay off or fund, right, war expeditions, right, and fund the wars. But ever since World War II, our taxes, the federal tax bracket has actually gone lower and lower and lower, all right? But in my opinion, taxes are probably going to be going higher in the next 10 to 15 years.
Wow.
Because of how much debt the United States has built up over the last 100 years.
Yikes.
And it's scary, it really is. So, just understanding where taxes are going, right? What tax bracket you are in now, you'll really be able to put together a sound plan where you never have a tax burden, especially in your distribution years of your life.
Okay, so I know that was a lot of information, but It's all very useful information. So make sure you guys subscribe, like, and comment, and keep up with us, because again, guys, these are things I'm going to try to get people on that can help and give information essentially for free. You guys don't have to pay anything. Going forward, just do your own research. Get more comfortable working with somebody, and if there's somebody that you don't trust or whatever, I'm going to leave Eddie's information down in the description below. So if you guys have any questions, you can email him, you can contact him, and ask him whatever you guys want to know, and maybe work with him. I know he's working with high net worth individuals as of now. He can't disclose who, but see you guys in the next one. Thank you, Eddie.
Thank you for having me.